So tonight's keynote presentation, guys, is how to buy rental properties, or how to buy properties in general. It doesn't have to be just for rental property, because we use this for multiple different exit strategies, but how specifically to buy properties without relying on getting a loan from a lender, without relying on getting a loan from a bank. And for us, this has been an incredibly powerful strategy in terms of building our rental property portfolio and for us building our wealth. And it's something that we started doing very early in our investing, and it's something that probably, like many of you guys in the room listening tonight, you're like, I don't know if that's possible. Yeah, well, we thought that too until we started doing it, and we're like, okay, yeah, this is possible. In fact, it's something that we want to do on every single deal that we do. So I'll go through what that looks like. I'll go through how you guys can find these types of properties as well. So for us, what we found is buying property subject to is probably one of the most powerful techniques that we use as real estate investors, because with the average price in Austin, right, the Austin area being around $400,000, even if you've saved up a lot of money, even if you've made a lot of money as doing other things, or even as a real estate investor, $400,000 is not going to get you very far in terms of buying properties here in the Austin area. And if the only way that you're buying properties is, for example, using your own cash, if you've only saved up $400,000, that means you can only do one property about every 6 months, because it's going to take you 6 months to go through the purchase, the renovation, getting it under contract, and actually closing on the sale. So that means you can only do it twice a year. Even if you're making $60,000, for example, on a flip, that's probably not enough to get you to leave your current place of employment. It's good, but it's not maybe enough. So for us, what we look for are properties where we can buy the property subject to the seller's existing loan. So there are 3 different things to notate that happen during a closing, during a purchase of real estate when there's a loan in place. Number 1, there's the general warranty deed. The deed says this is the person who owns this property. So the deed transfers from one person to another. The 2 other documents that are commonly filed at the I'm going to keep going. Maybe I'm not. If it does that one more time, I'm going to grab the other mic. In fact, I'm going to grab the other mic right now just to be safe. So, like, I have an awesome staff out there that help check you guys in, but there's something about this doesn't start to mess up until my awesome staff actually leaves the room. So me telling everybody, like this is what happened, they're like, oh no, when you walked in there, when you were talking, it was fine. It was like, well, ish, right? So let me try and switch mics and see if that works a little better.
When Phil was presenting, did you hear, did his pop too? No? Okay, this was okay. So I did the crack mark, is that what you wanted?
And it could be where I stand. Is this picking me up at all? Not really. It is a little bit. Maybe if I put it like probably on the inside. Let me see. All right. Is this better? Better. Real estate investor and sound gal. I don't know. I'm not liking this. I sound like I'm about to take off. Is this any better? Sort of. Guys, people say I can't hear you. I have a soft voice. Get closer. There's some seats. It's okay. I won't bite. So, buying subject to. So the deed transfers to the new owner. Then there's 2 different other instruments that are created. One is the promissory note, and one is the deed of trust. So in the case where a new buyer is getting a loan, for example, from a Wells Fargo, there's a note and a deed of trust payable to Wells Fargo. And Wells Fargo in that note and deed of trust basically says, if you stop paying me, I'm going to use these 2 security instruments in order to foreclose on whoever has the deed, okay? So when we're buying a property subject to, for example, the person who owned it before is deeding that property over to us, but the existing loan is not getting paid off. So now I'm making the payments on the original owner's existing loan. We also go through the process in order to protect the seller of creating a new note and a new deed of trust, naming the seller as the banker, if you will, as the Wells Fargo, Chase, Bank of America, if you will. Why do we do that? Why do we do that? What does that give the seller the ability to do? To foreclose on me in the event that I stop making payments, right? So we put basically the seller in the same position as the original Wells Fargo, Bank of America. I'm just using Phil's mic, so I can. Okay, well, be careful, because if you turn me up too loud, it sounds like I'm about to take off. Okay? Yeah, so we can try that though. So it puts the seller in the same position, for example, as a Wells Fargo, Bank of America, Chase, where they can foreclose on me in the event that I stop making payments. So this is one of the forms of buying a property that we like to use, because instead of using $400,000 of our own cash, what the average price house in Austin is selling for, we may only be using $100,000 of our own cash. So instead of being able to buy one property every 6 months, we might be able to buy 4 properties every 6 months. And if you're making $60,000 for all those 4 properties, that's $240,000 in 6 months, and then over a course of a year, yes, like $480,000. Does that make a big difference in terms of how much you can make as a real estate investor? Yeah, and the answer is yes. Now, obviously, you have some awesome and incredible hard money lenders here who can help facilitate these transactions as well. But when you're buying a loan subject to from an existing lender, or pardon me, from an existing owner, those interest rates from that existing owner are typically in the 4 to 8% range, which is a lot cheaper than, for example, borrowing hard money. So for us, this has been a great way to leverage capital, leverage the money that someone else has already put in place, and just be able to buy it by usually we are bringing money to the closing table. Usually we are reinstating a loan. The only reason why they're talking to us is because there's some type of motivation. Usually that motivation has something to do with the fact that they're behind on their payments. For us, it's been a great way to pick up rental properties, buy renovations, so buy fix and flip properties. It's a great way to buy homesteads. It's a great way to wholesale properties too. So I know some of you guys are specifically looking at getting started and maybe getting started in wholesaling. Is it a lot easier to wholesale a property when it already comes with, oh, and by the way, don't worry about the funding because we're going to go ahead and take over the seller's existing loan. And instead of you having to bring $300,000 to the table, you only have to bring the amount to reinstate the loan and then my fee for putting this together. The answer is, yeah, that property is going to sell a lot faster than if you just say, yeah, here's a property, now you got to go out and get your own financing. So you just increase the amount of your buyer pool. Whenever you increase the size of your buyer pool, you increase the amount of money that you can possibly sell that property for, and you decrease the time during which you can sell that property because it's going to sell a lot quicker. The details can get a little complicated. We'll go through some of them as we go through the presentation tonight. For us, for our long-term buy and holds, do we want a low fixed rate interest rate? Yes, we do. There are certain circumstances where I don't care if I have a 7, 8, or 9% interest rate. Under what circumstance might it be where I don't care what the interest rate is? If it's a high interest rate. I'm not going to keep it long. What's enough? That's perfect, yeah.
If it's seasoned or you've got a lot of equity.
If it's seasoned, so in the event that, so on a 30-year mortgage, the sweet spot on a 30-year mortgage is roughly year 17. That's where you go from paying mostly interest on that loan to mostly principal on that loan. So the effective interest rate on that loan actually goes down over the course that you own it, because now you start paying the sweetest part of the loan, which is all of the principal payment, and you had somebody else for the last 10 or 17 years paying the unsweetest part of the loan, which is all of that interest payment. So those are some instances, for example, where I wouldn't mind taking over a loan that has a higher than normal interest rate. Also want to make sure you guys review your contracts with an attorney. For us, we're 14 and a half years in. I think this is the sweet spot right here. I'm going to stand like this and that. So the sweet spot, so for the title companies, I mean, we're 14 and a half years of doing this business. Every time we do a closing, we close with a title company because we want the title insurance, because we want the title commitment, because we want the title research done to make sure that there are no gotchas that come up on the title search, which in many cases, especially when you're dealing with a motivated seller, there are surprises, there are liens, there are judgments. Some of these title commitments read like a telenovela with, you know, divorce and alimony and child support and bankruptcy, and you know, it's just like you're reading a disaster in process. So make sure you always close those contracts with a title company. It's the safest way to do it. Now, can you do a tabletop closing? Yes. Have I done them? Yes. Do I like to? No. But highly, highly, highly recommend. And I'll tell you a quick story. One of my colleagues in San Antonio was investing and kind of knew a little bit about buying subject to, and she wanted to save a little bit of money. So she was penny wise and pound foolish. She just created a general warranty deed and just took over the property subject to. Well, she took over the property subject to from a woman who had passed away. And she got the heirship information correct, so she had the person's heirs sign off on that deed, deeding it over to her. What she did not do is she did not do a full title search. So she looked at the title on the property and she said, title on the property looks good, the title on the property looks strong. What did she not look at? The owners. So guess what one of the owners had? An IRS tax lien against him for $15,000 that he had no intention of paying anytime soon. So as a result, she now owns a property subject to where there's still that outstanding debt on it. So at the time that she decides to sell it, she may also be responsible for paying off that heir's IRS debt, which kind of sucks, right? So now where do you think she closes every time she does a deal? She closes at a title company where they go and find this sort of stuff, because there are some very tricky details when it comes to this. How many of you guys are aware of or thinking about, well, wait a second, what about the due on sale clause? Okay, good. So you've done some research. Nathan, you've been researching this for 8 years. You didn't
It's like if you have an LLC, it matters more.
okay, now you keep studying. So is it Regina? Regine, okay. I can only see the first part. Okay, now I got it now. Okay, good. Well, it's because of my glasses. If I didn't have my glasses on, I wouldn't even be able to see that you were a person there. But so the due on sale clause. So just about every single loan that's been originated over the last 20 or so years has something called a due on sale clause in it. The due on sale, I've got it copied and pasted up here. You guys can read it if you want. I'll kind of summarize it for you. Basically what it says is this. In the event that the property is sold, and in the event that the property is sold and the underlying lien is not paid off, the underlying loan to Wells Fargo is not paid off, that Wells Fargo, as an example, I'm just using Wells Fargo as an example, they may, at their option, call the note due and payable in full. You don't pay off the note, and you sell it, I may, at my option, call the note due and payable in full. What do you guys think about that? Does that make you nervous? Does that make anybody here nervous? So yes, people have done research about it. Like this is the thing that kind of freaks them out about buying subject to. This is the thing that freaked us out when we first started investing back in 2003 about buying subject to the existing mortgage. We were very afraid and very concerned that a lender might call the note due. But as we looked at the language in here, does it say that, oh, we're calling the note due, we're gonna track you down, we're gonna find you, we're gonna call it due, we're gonna foreclose on you immediately? Does it say anything like that in there? Oh, really? No. It says I may at my option, right? It's like I have the right. You have the right to do it, but the truth is that as long as you are making the monthly payments each and every month on time, they are not going to call the note due. And I'll tell you, all the properties that we bought subject to the existing mortgage, every single one. We reinstate, and then we make the payments on time each and every month. And just about every loan has one of these, what we call a due on sale clause. But historically, lenders never call this, use this clause on a performing note. Now, if you stopped making payments, here's what I can guarantee. Yes, that loan is going to get called, but it's not going to get called based on the due on sale clause. It's going to get called based on the default of payment clause, right? So the banks are not, so there are 254 counties just in the great state of Texas, 254 counties in the great state of Texas. Just in the Austin area alone, there are about 30,000 different transactions that take place on the MLS, plus there are another, and that's just on the single family houses, plus there's probably another 5,000 or so that take place off of the MLS, okay? That's just in Austin. In Houston and Dallas, there are about 100,000 sales a year. In San Antonio, there are close to about 30,000 sales a year. So in the great state of Texas overall, there's probably over 200,000 houses that sell every single year, yes? So do you think Wells Fargo, Chase, Bank of America is going to, because each one of these counties, you have to file at the county. It's not filed at the state level, right? Do you think they're going and pulling the deeds to see, oh, I want to see if this loan and this person's address matches what's currently in the deed history? Do you think Wells Fargo, Bank of America are doing that? At least not since I have been investing, they have not been, okay? I'll just say that. And is every county like fully online with all of their deeds? You know, the answer is no, not even close, right? The answer is no, not even close. So I don't see the lenders actually doing anything like that. I don't anticipate them doing anything like that, at least not in the near future. And I'm just talking about Texas having 254 counties. That doesn't include all the other 49 states in the United States where they also have to go through this exercise, right? So what we found, again, is that as long as the note is performing, a lender will never or rarely call that note due. A couple of diversions. We've seen some investors do a couple of little tricks to try and get approval, if you will, from a lender. There's one who will basically say, I'm sending you my first payment. If you don't like the fact that I'm buying it subject to the existing mortgage, then just go ahead and send me back this $15,000 or $20,000 reinstatement fee. I'll deed it back to the owner. You can foreclose on them, and we'll call it a day. But of course, when you send a payment to Wells Fargo, are they like, oh look, somebody wrote me a letter, we better read it? Or are they just like auto-processing and depositing those checks? The answer is the latter, obviously. For us, whenever we buy one of these properties subject to the existing financing, and we keep it as a rental property, we set up a new LLC every time that we do that. So, our tax return is 200 pages long, and it's just part of being in the business of being a real estate investor. That's just how these things work. And it is expensive for me to do this, because I have to file the paperwork for the LLC with the state. I have to pay an attorney to do this for me, and every year I have to pay a CPA to do a franchise tax return for me on this. And then, of course, my CPA also does all of my Schedule C's and all of my Schedule E's for all the different businesses I own and all the different rental properties I own. So it's kind of a pain, right? But this is a thing that I have learned from other coaches and mentors who have taught me how to do this. And I'm not someone who says, yeah, tell me your best practices and then does it the opposite way. I want to kind of stay in line with what they're doing. And there's something, and I'm going to go down a little bit of a rat hole, guys, if you guys will forgive me, something called the Garn-St. Germain Act of 1982. And basically that says if you own a property and if you do some, for example, estate planning, like move it over into a trust, that you cannot get the loan called. The bank cannot call that loan. So when I set up a new LLC for when I'm buying a property as a rental property, I have a certain naming recognition that kind of falls in line with something that might look like it's under that Garn-St. Germain Act. Because when I buy it, the new LLC that I create is the last name of the last owner, dash the street address, comma, LLC. Why do I do that? Because if Wells Fargo, Bank of America, Chase, whoever were to actually go in and look at all 254 counties in the great state of Texas and all 200,000 records, and they looked at this one and they said, well, Nathan Shepard is the person who has a loan on this property, and then when I look at who is the current and who's currently entitled according to the tax office, it's Shepard-1234 Main Street, and the address of the property is 1234 Main Street, and Nathan's last name is Shepard, so I'm thinking these things are probably some trust, maybe a new trust, maybe some estate planning, etc. So for us, that's something that's given us a little bit of air cover there to make us feel comfortable about it. Plus, let me ask you guys, how many of you guys have already set up your company LLC in the state of Texas? Okay. So, Debbie, yeah? So, when you called the state of Texas and said, I want to set you to call them, but I'm just going to do this. And you told them, I'm starting a new company, and I want to name it Texas House Buyers LLC. Is that one available? And they say, yeah, Debbie, that train left the station like 20 years ago. And then you're like, well, how about Austin, Texas Home Buyers? Like, I got this one, right? And they're like, yeah, no, that one left the train station like 18 years ago. And then if you go to them and say, well, how about Shepard-1234 Main Street, LLC? Yeah, no, that one is available today for a special discounted price. So that's the other thing. When we're buying these properties subject to, and there are rental properties, we'll put in a name of an LLC that we don't own, but it'll just be that naming recognition, and we don't finalize and purchase that LLC until the day that we purchase that property. Why is that? Because not every transaction makes it to the finish line, right? And it would be really annoying to me if I had Shepard-1234 Main Street and I did not own Shepard's house on 1234 Main Street, right? So that's how that's kind of how we've set it up to put these things together. Now that is for our long-term buy and holds, where we want to be a little bit cautious with the bank, right? For the properties that we're buying, fixing, and flipping, meaning we're only going to hold these properties for about 6 months on average, we'll put them in what we call our flipping LLC. So we don't set up a new LLC for the property that we're only going to have for 6 months, because, man, it would take them more than 6 months to realize that we purchased the property and to say, hey, no, we don't like that, and then to go through the foreclosure process with us, right? So we're not so worried about those that we're buying, fixing, and flipping, but the ones that we worry about are ones that we want to be a little bit more cautious on are the ones that we buy and keep as rental properties, and that's been our process. So let's run through all the different steps. So first, find the property. Oh, dang it. I went a little too fast there. So first, find the property. Explain to the seller that you're going to buy the property by taking over the payments, which has benefits to both of you, both the owner as well as you, the investor. If they're behind on payments, which about 95% of the properties you're going to buy subject to, they're going to be behind on payments. Guys, the only reason why they're talking to you, the investor, and not talking to a realtor and putting it on the MLS is because they have some sort of a problem, and that problem needs to be solved. Now is good, right? Now works too, right? So that's why they come to us as real estate investors. So for us, whenever I buy a property subject to, I'm helping their credit along. Now, it is a process, right? It's not going to happen over. Someone asked me, well, someone's had another investor, so sweet, she's really trying to help this family out. She's like, well, how long after I buy it subject to will their credit score go up? I'm like, it's going to be a while. And she's like, well, they're trying to rent an apartment. Like, what do I do? You need to find them an apartment where they are open to a variety of ranges of credit scores, including some that have a leading digit of 5. Right? So like you have to kind of look for those sorts of things. But you do improve their credit, but it does take a little bit of time. So when you buy a property where they're behind on their payments and they probably have a low credit score right now, and you pay off that loan completely, now the only thing that's on their credit report are credit cards from Macy's and Pier 1 and Sears. with a maximum credit amount limit of like $5,000, let's say, for example, how long is it going to take you to build your credit score up when you just have a bunch of dinky credit cards on there? Well, it actually takes longer than if we buy it subject to, and they have a $300,000 loan on there, then now I just brought current. And I don't know, I think they just throw a bunch of spray paint a bunch of numbers on chickens in a room and throw them into the room, and the first three that come out, like, that's your credit score, congratulations. I don't know how this stuff really, no one really does, right? But when you have those higher dollar loan amounts and they're performing, your credit score goes up at a much higher pace and a much higher rate and a lot faster. You can get to these higher numbers, like these 800s credit scores, than if you just have a bunch of little dinky credit cards on there. So does everybody got that? Yes? Even if it is just throwing chickens into a room and they come out and that's how they determine your credit score, I don't know. But that is a way that we can help someone over time improve their credit score so that they can go out and buy other stuff, qualify for apartments, get all those other things as we start to repair that credit for them over time. We get the property under contract. We use a truck contract. Does anyone in here not know where to get the contract that we use here in the great state of Texas? Does anyone? How come you've been researching for 8 years and you don't know this? Like, yeah, dang. But okay, yes, TREC. Google, good night, guys. Google TREC, T-R-E-C. That stands for the Texas Real Estate Commission. The website is just Google TREC. It's the first thing that comes up. So it's trec.tx.
Texas the word.
Texas the word. .gov. .us. What the hell were they thinking when they came up with this URL, right? I mean, so just Google TREC.
They weren't investing.
Just Google. They don't want anybody to find them. No. Yeah, just Google TREC. T-R-E-C. It's the first thing that comes up on the TREC website. They have something called forms. You can click on that thing called forms. There are 40 different forms out there for you or a realtor or anybody to use. So when I say anybody, I mean anybody. You don't have to be a realtor to use the TREC forms. You got to be really clear about that, because some realtors will say, oh no, you have your realtor. No, you don't. You can use this, okay? Now, if you are buying a single family home, you need to look for it doesn't just say contract, okay? It says 1, 2, 4 family contract. Brilliant, yeah? That's the contract you need to look for when you're buying a single family home. They have 2 other amendments on there, addendums on there. One is the owner finance addendum, and one is the seller finance addendum, or I'm sorry, one's something that's called assumption addendum, and the other one's called the seller finance addendum. You will fill out both of those forms too. One says all of the details for the owner's current loan, and one says here's all the details that we need for the new loan that's being created. What we do is we create a wrap, or it's called, the term is called in the title industry is something called a wrap-around mortgage. So it wraps around the existing mortgage. The existing mortgage is not being paid off, but this is a new mortgage. And that wrap is what gives the seller the ability to foreclose in the event that the buyer stops making payments. Yes? So those are some of the forms that you'll want to look for as you go to the TREC website. You'll take that contract and all of the addenda and some other information with you, specifically if you have the seller's old note and deed of trust, give that over to the title company. They'll be able to use that to be able to create the new note, because when they create that note, they reference page number 151 of the Travis County property records. This is this long thing that they want to put in there to make sure they're referencing the right property and creating a note that will stick, meaning that will pull up in the next title run whenever this person goes to resell that property. Buy the property, again, the deed transfers. Now you will usually be paying money of some sort. Usually it's number 1, a reinstatement, And occasionally, number two, it is money to the seller in the event that there's enough equity to get the seller money in there as well. And then obviously you're paying the title company to put all of the paperwork together and do this transaction for you. Exit strategies, again, you can use this to buy properties that you ultimately buy, fix, and flip. You can use this to buy rental properties. You can use this to buy homesteads. You can even sell it on a rack. You can even wholesale it to another investor. And there are infinite, not infinite, unless 5 is infinite tonight. So tonight only, 5 is infinite. There are a lot of different cool things that you can do using this strategy. And again, this is kind of this is a complex topic, and I know, is anyone thinking like, wait a second, you're telling me that someone's going to let you take over payments on their loan? Who's thinking that? Who's thinking like, I would never do that? Who's thinking that? It's okay. Raise your hand. Let me know who you are. Yes. Yes. Okay. Let me ask you a question. David. Yeah? Yeah. David. I need like 3 minutes. 3 minutes. David, are you married?
Yes.
Sorry, ladies. Do you have a job?
Yes.
Okay. Do you have a dog?
Yes.
Is it a he or she?
She.
Is she alive? Yes. Do you have a truck?
No.
No. Do you have a vehicle?
Yes.
Does it work?
Yes.
Okay. David is not the subject of a country music song. Yes, we can all agree on that. Yes? Yes? Yeah? David has his life in order. Thank you for making everything yes. But again, sorry ladies that he's taken. So I'm even making the people who don't want to smile, which like makes me so happy. Okay, so David has his life. David, listen, let me tell you something. You already know this. You will never sell me your house subject to the existing mortgage. Never. Because your entire life is in order. But David, if you had some decrease in income and or some increase in expenses that puts you very behind on your payments and you were about to go into foreclosure,
Might change the answer.
Might change the answer, right? All of you guys in this room have your life in order like David, okay? Or close, right? Some I mean, David's got it pretty good. But all of you guys have your life in order like David. And none of you guys are ever going to sell me your house subject to the existing mortgage unless there's some type of a change like what we just talked about. But the problem is people like David, and I'm not saying that you don't believe that this is okay. Okay, so we're having a conversation here tonight. We're glad you're here because I was about to set him up with some of the other lovely single ladies. Don't ever leave David alone, because. But the issue is, you guys who have your perfect lives in perfect order, you all think, yeah, who would ever do this? No one would ever do this. You have to divorce yourself from your current way of thinking, from your current reality, and you have to put yourself in the shoes of somebody who has a very different life than what you do. And because I see so many investors kind of like talk themselves out of this, because they think, well, I would never do this because you don't have to, because everything is in order. But the people that we work with on a regular basis that we're buying at these very deep discounts at, right? So when we buy a property, we buy it 70% of ARV minus repairs when we're buying it to buy it, fix and flip it. And that's the only number that we're gonna buy at, okay? They're only gonna sell it to you if something's gone terribly wrong. If the house needs a lot of work, if they've lost their job, if they're facing foreclosure, if they're the subject of a country music song. So I just want to make sure that kind of digests for you guys, right? So to think about it a little differently. And guys, I have Graham back here, and he's telling me, I think, is there anyone in here who has not joined membership, who is thinking like, oh, I might join membership tonight? Anybody? Okay. If anyone is in here who is thinking specifically and or only interested in commercial real estate and wants some additional training in commercial real estate and has not already gotten membership tonight, is any of you folks in here who specifically and are only interested in commercial multifamily and has not gotten membership tonight? You not? You got a membership. Okay, you're good. So just want to make sure, because we cover some of the commercial training at the 3-day training, so I want to make sure that we're good. And Graham, I think, yeah, we're good. Awesome. I just want to make sure. So Graham has got 4 young kiddos at home, and he's giving me the signal like I gotta get my wife. His wife is calling. Okay. And he does not want to be the subject of a country music song tonight. So he's telling me it's 9 o'clock and I want to go home. So yeah, we're good. Awesome. Thank you. All right. So that's what we're looking for. We're not looking for the perfect person in the perfect situation here. So there are objections, and typically these are, the objections that we get. People will say, well, Shanoa, I loved everything you said. I love the price. I love that you can close before I go to auction. There's just one little thing that I want to go back over. I don't want to keep my listing loan in place. Well, hold on. For those people, again, we kind of have to bring them back around. But again, if you did not have equity in your home, or did not have a lot of equity, or it needed repairs, or you were behind, or you were facing foreclosure, or did you know? And this is the craziest reason that I've ever found for an investor buying a property. There are some people out there who just flat out say, I don't want to sell using a realtor. I don't, or they'll say, I don't want anybody coming through my house. I can help with that, right? But there are some people who that's a reason why they will sell this way too. And there are different situations like, illnesses and stuff where they just want to kind of, or they don't, there are other people who have literally said to me, I just don't want my neighbors to know. I'm just going to move out in the middle of the night. I mean, but for some of them, yes, right? So there are different situations where someone may say, yeah, I want to do this, or I want to go this route. So some of the ways to overcome objections is just to kind of ask the obvious question of, why would I buy your home, reinstate the loan, typically somewhere between $10,000 and $20,000, sometimes even much more than that? Why would I do that and stop making payments? Why would I do that and then do a $50,000 to $80,000 renovation, which is pretty common in Austin, right? And then stop making your payments? If I'm going to throw away my money like that, there's a place in the great United States called Las Vegas, where I could have a lot more fun throwing my money away. Yes? Yes. So, but instead I'm a business person, I have skin in the game, right? The likelihood of me reinstating, doing all these repairs, and then stop making payments doesn't even make sense on this earth. But let me tell you something, and this is one of my favorite ways to overcome the objection that I love to say now. Nathan, I'm going to just keep picking on you. Nathan, I don't know whether you are a religious man or not, but here's what I can tell you. After I reinstate your loan, and after I do a full renovation on your house, whether you are a religious man or not, every night when you go to sleep, you will say a little prayer, and it will go something like this. Dear Lord, I've had a rough time. Somebody wrote a country music song about me. But this lady, she came along and she bought my house. Dear Lord, please have her get hit by a bus so she can stop making payments. And so I can use the note of deed of trust that she gave me at the time of closing to foreclose on her. Dear Lord, I just ask this one thing. In Jesus' name we pray. Right? Wouldn't it be like the best day of your life? It'd be like the best day of your life. Right? Yeah, no, do you think you would foreclose on me a lot faster than it took Wells Fargo to foreclose on you? The answer is, oh yes, right? So that's a way to kind of lighten the mood a little bit and get them to say, oh yeah, no, that makes total sense. Some of the tricky details. Verify the loan balance. You'll get an authorization to release loan information. You can pick up any of these off the internet, but some banks do have their own very specific authorization to release loan information forms. You'll fill this out. This will give you the ability to get both the payoff and the reinstatement. Your title company will require both of these items in order to close on this property. Please be smart when you are ordering the payoff and reinstatement, and order it good through the date of the auction. Because even though you have the best intentions to close 2 weeks before the auction, sometimes there are title issues or other issues that come up that delay the auction, and sometimes the title company will say, oh, well, we need a new payoff, or we need a new reinstatement. And when a loan is behind, it takes a lot longer to get those documents. Loan's current, they can get it to you pretty quickly. But if the loan's behind, because they've got to calculate all of the fees, late fees, attorney's fees, all of that stuff, and it really slows down the process. Again, we talked about buying it in an LLC. That's what I do. I do have to let you know I'm not an attorney, CPA, financial advisor. I highly recommend that you get one. I'm sharing with you what I do. It's not necessarily a recommendation for what you do, but your financial advisor, CPA, whoever you're talking to with a license will tell you what to do there. For us, we always buy a new insurance policy. You guys met Mike Munzingo tonight, the insurance guy. He's an investor first, insurance guy second, but he knows how to write these specific types of policies, and they are different than your regular homeowner's policy. They're different than your regular rental policy, because you have to name 3 separate people in this new policy. You have to name yourself or your company as the new owner. You have to name the mortgage company in the mortgagee's clause, just like Chase is named in the original owner's clause. And you have to name the seller who you bought it from as an additional insured, because the bank looks at that. They do compare that to make sure the right person's got coverage there. Verify all liens. The title company will do this for you. Always go to the title company. Get a copy of the promissory note as well as part of your due diligence. Change the mailing address. Usually every March, banks do an escrow analysis, and in the escrow analysis they say, this is how much we've collected for property taxes and insurance, and we need to, and they send a letter to the owner or the borrower, and they say, you can either make a one-time payment of $600, or we can increase your monthly payment amount by $50 a month, as an example, right? You want to get that letter. The way that you get that letter is you change the mailing address to you or your company's mailing address. Occasionally, the lender is going to send an escrow refund. Make sure you get a power of attorney at the time of closing. Let me just be clear. This is a limited power of attorney, limited to dealing with transactions that are associated with the house. If you go out and you get hit by a bus, I cannot unplug you. So just, there's a difference here. Limited to the house. You will get a 1098 interest expense payment, or interest expense form. So by January 31st of every year, and those of you guys who have loans with Bank of America, Wells Fargo, etc., by January 31st of every year, you get a 1098 interest expense statement. So this is saying, this is how much interest you paid Bank of America, Wells Fargo, etc., over the course of the last year. Now, if you are the current owner, even though it's someone else's name on that 1098 interest expense, and even though it's someone else's social security number on that 1098 interest expense, you will be the one to write that interest expense off on your Schedule C and or your Schedule E on your tax return. Now, some of you guys are saying, oh gosh, this sounds a little That's right. Well, let me tell you two things. Number one, I have verified it with my CPA. Number two, and this is probably way more important than verifying it with my CPA. Number two, about 5 years ago, I got a love letter, you know the one, from the IRS. It said, "Dear Shanoa, your social security number is 1234567. Dear Shanoa, what we can't understand is why you are taking a 1098 interest expense on social security numbers 1, 2, 1. So, okay. Dear Shanoa, we've taken the, whatever the word is I'm looking for right now, to go ahead and pre-calculate how much we think that you now owe us, and it is this. Please remit payment immediately." And I said, "Oh shit." So I have had the opportunity to step out of my ivory tower of teaching you guys how to invest in real estate and step into the IRS's world. And so the first thing I did was I called my CPA and I said, "Well, wait a second, you told me that I could do this." He said, "Chill out, you can do this, now you just have to explain it." So I showed the HUDs where I purchased the property. I let the IRS know that I bought the property subject to the existing mortgage, right? And that I've been the one who's making the payments on, the person who can write off the interest expense is the person who paid the interest expense. And so I let them know that I paid it, and then I showed them copies of the 1098 interest expense statement, which I received because I changed my mailing address to make sure that I got those copies, yes? So I sent that back to the IRS, and I prayed. And then the IRS later sent me a letter that said, "Dear Shanoa, we're good." And I said, "This shit really does work." So I have taken the opportunity to test it for you with the IRS, and they say it's okay. This is sample authorization to release loan information. Again, you can find this online. Some of the advantages when you use this property: the loan is in your the loan is not in your name, but the deed is, which I love because I control the property. For us, we usually buy it in an LLC. For us here in Austin, we focus on high appreciation properties, which is everything in Austin, basically, right? Well, at least right now it is. The tenant pays down the loan. We get the appreciation, and for us, it's been the essence of wealth creation. So the truth about this is a lot of people, like David, and maybe some of you other folks in here, don't think like, who would ever do this? Who would ever want, no, listen, let me tell you something, guys. Whether it's this strategy or anything else that you do as a real estate investor, I just want to make it real clear, none of you guys are plan A. None of you guys are plan A. Plan A is, I have equity, house is in great shape, I'm going to hire a realtor, I'm going to stick it on the MLS, and I'm going to get the best price out there. We're not plan A. Plan A for these people left the station 6 months ago, 12 months ago. In some cases, I talked to somebody the other day, was 3 years behind on payments. Yeah, that plan A left. We're like plan Z. But in some cases, we're the only people who can get this job done because we have this knowledge, this specialized knowledge, because we can use strategies like this, and because we can help them quickly, right? And because cash, right? So the truth is, it does eventually get awkward managing someone else's loan, adjusting the payments every year, and sometimes even more often than that as the loans get sold to other loan servicers, etc. But for us, we use it every time we can. Anytime someone brings me a deal, and that's all the time, I always ask the same question: can I get it with the loan in place? Can I take over payments? Because I don't want to buy a property for $400,000. I want to buy a property with a $40,000 reinstatement and then pay for the repairs. That gives me the ability to keep my powder dry, to do this over and over again, many more times than if I were investing all in cash on one transaction. Does that make sense? For 3 of you. Really kicked ass and did a great job in here tonight, and I appreciate you guys reaffirming that. But guys, this is the end of the presentation. We do go through this in much more detail because we have a lot longer period of time to do it. When we do the 3-day training event, as a member of the association, you get to attend the 3-day training event, and hope you guys decide to join us. I think I even entertain our vendors and sponsors who hear me talk all the time. Thank you guys for listening to it. Appreciate it. And we'll see you guys soon. Take care and good night.